Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. US GDP and the ECB were key drivers of markets yesterday, with the GDP print for the US coming in much hotter than what was expected. It's another point adding to the relative strength of the US economy vis-a-vis the rest of the developed market economies. ECB held its rates as it faces the prospects of a weak economy. Good morning, JK. If you could rate the central banker press conferences, what's your sense of yesterday's ECB press conference? Like, where do they fit in the hawkish to dovish scale?
Good morning, Swaraj. Yeah, I would call the ECB's decision and the statements as dovish pause, definitely, because ECB not only held the rates steady, but almost indicated that the peak rate is in, and that's what even the market is concluding. They reiterated in a statement that holding borrowing costs at a level for long enough will make a substantial contribution to bringing CPI to 2% target. So this is read as, they don't have to raise rates further, and the inflation target will be hit as well. And, they also made clear statement about the economy weakening. And yeah, I think Lagarde has, or rather ECB has never been as dovish on their economic outlook as they have been yesterday, and that is also another indication that that policy rates will not be hiked immediately. And the only hawkish statement, which it could be read as a hawkish statement, that she made, was that a pause does not mean that we will not hike again. But there is little doubt among investors and analysts that the high point for eurozone borrowing costs has been reached following back-to-back moves starting in July 22. And yeah, definitely, unless there is a bigger rise in oil prices due to Middle East war or anything, I think ECB is done as far as their rate hike is concerned. But one important point for future months is that the policymakers agreed to debate the PEPP reinvestment end date, which means that there will be liquidity withdrawal from the market, and that could be actually some sort of a tightening, and also maybe supportive of the euro as well. And then the other big event was the US GDP data. GDP data came far stronger than expected, and at 4.9% versus 4.3%. 4.3 itself was a big rise from 2.1% that was seen for the last quarter. And biggest contribution for this came from personal spending, that jumped to 4% from 0.8%. This is the highest since 2021. And resilience of the job sector, which continues to fuel the household demand. We also had government spending that grew 4.6% annualized, and contributing about 1.3 percentage to the headline GDP growth, while inventories also added 1.3%. But the dovish part, or if you can call it the good part, was that the PCE core prices cooled to 2.4% versus 2.5% expected. In the last quarter report, it was at 3.7%. So overall, one more perspective is that it is a backward-looking number. So while we will be interested in assessment of the current quarter growth as consumers face higher interest rates and the student loan repayments have started, credit card borrowing costs are at the highest since records began. Car loan and personal loans are, soaring. Rates are soaring as mortgage rates are up at 8% now. So now some forecasters are already talking about 1.5% in fourth quarter. So if you want to be forward-looking, you ignore the 4.9% number, and also the fact that the underlying price pressures have actually cooled off. So that's the thing about the GDP data. That's the reason why we did not have a big reaction in the markets also to the number. Then we did have a jobless claims. It came higher at 210,000 for the weekend at 21st October. That was an increase of 10,000 from previous week's number. Important point here is that the moving average increased from by 1,250 to 207,000, and the continuing claims, which represents the number of people already receiving and continuing to receive the benefits, was at 1.79 million, rising 63,000 from the previous week. So these are again cooling job market that is evident clearly. Durable goods also, which is the second tier data, also rose 4.7%. But then again, it was heavily influenced by the aircraft orders. And if you strip out those, actual growth in the durable goods orders was 0.5%. So overall headline number, very, very clearly indicating that US economy is doing well. But when you read, deeper into it, you feel that, actually things are cooling off. And, on the other side of the Atlantic, we had this UK CBI retail sales balance, which was at one of the lowest since October last. That is, so it is at minus 36 versus minus 14. So that, there are signs that, overall all the major economies are definitely cooling off. Now, as to the markets, yields, with all the bearishness around bond levels, and we saw another retreat from 5% plus levels. 30-year dropped from 5.13 to 4.97. 10-year from 4.99 to 4.84, and even 2-year from 5.14 to 5.04. The catalyst appears to be the GDP data, while beating on the headline, was softer in details, as I explained. Good 7-year auction. Again, this was a contrast to the auction of 5-year paper, which happened the previous day. A very good result. And then the general fragile risk sentiment, meaning the stocks getting sold off and risk assets being under pressure, also added to the buying sentiment for the bonds. Also, the release of weaker than expected inflation within the GDP data and possible disposal income supported the market sentiment for buying the interest rates. As to the stocks, Nasdaq fell 1.8%. It is now officially in a correction territory after having fallen 10.9% from its July high. S&P 500 is just less than 10% down. So it's not very far, and both of them are not very far from the 200 moving average, but that's a technical part. But what's driving these is poor outlook from major companies for the current quarters, particularly after the big tech company Google giving a poor outlook. It was the turn of Amazon to give a almost similar outlook for the current quarter. So that led to the stocks getting sold off. With all the headlines speaking very positive about the US economy, USD was actually underperforming and was down for the day, reacting to another retreat in yields. Euro's performance in particular for me has been impressive, as the recent weak data of PMI and dovish pass-in rates did not succeed in breaking it below 1.05. Also on the yen, where there's a lot of focus, speculation was rife that there was a Japanese intervention which traded at 150.8 before dropping close to a big figure in a matter of seconds, but has since recovered. All eyes are on Bank of Japan next week, where they could tweak the yield curve control that may be more effective in stopping the yen's fall than mere intervention. They would also be taking note of the Tokyo area CPI published today, which came much higher than last month and above forecast of 2.7%. There have been barrage of verbal interventions from the Finmin as well. Now, if you look at the other currency in focus, the dollar CHF has seen a firm cap above 7.3 for several sessions now. So there has been euro strong support at 1.05, yen above 150, and then CNH above 7.33. They are indicative that possibly dollar is plateauing off its gains. Now on the rupee, we had another test of near all-time lows for the rupee as risk sentiment took a big hit. USD was stronger across the board during the day. Adding to fresh weakness was another hefty FII flow of over 7,700 crores, though the related demand seems to have been well met by central bank intervention. In 2 days, we have seen nearly 1.3 billion of outflows from the FIIs, while the stock index has fallen over 5% from the recent peak, pushing it to short-term oversold territory. We could see some small rebound in the stocks, but that is, we need to see whether we actually resume an uptrend, because there are some other headwinds, particularly the oil prices and the outflows, which will be impacting the USD INR as well. But we do not see change in RBI stance as far as protecting the rupee from its all-time lows is concerned. So we should contend with 83 and 30 range once again. Just a few things that may be of interest to market participants. Turkey Central Bank raised its policy rate by another 5% yesterday to 35%, and that was expected, of course. Now, while the inflation rate is still above 60%, the recent approach of the Turkey Central Bank rising its rates heftily to rein in inflation is a very positive change of approach, and that's something that the investors will take note of. And we might as well see another rate hike in their next meeting. Also, if you can call it a small interesting point, Germany's economy is projected to dislodge Japan as the world's third largest in 2023, and Germany will be the third largest, and Japan will slip to the fourth position. This is as per the IMF's projection. Have a good day and good weekend. Thank you.
Thank you, JK. And just to quickly summarize, it was a dovish pause by the ECB, indicating that somewhat these rates are the peak rates and holding rates higher will bring down the inflation. US GDP was another highlight, and US GDP was stronger than expected. But as JK mentioned, one thing to keep in mind is that these numbers are backward looking. And the forecast for the next quarter is 1.5%. So that's something to keep in mind. So overall, the theme which I'm able to gather is that there are signs that the major economies are cooling off, but on a relative basis, US economy is hotter. So that's why we were seeing this somewhat of a buoyant dollar. And also one another interesting thing which JK mentioned was that despite all the headwinds for the EU, the dovish pause and the data, euro hasn't broken below the critical 1.05 level. So that's another thing to keep in mind. For rupee, strong outflows from the FIs as equities got sold off, but more or less there's no change in stance from the RBI. They are going to protect the all-time low as of now. So that's it from us today. Have a very good weekend and tune in on Monday for the latest in the financial markets. Thanks for listening.